You found an interesting coin. Cool website, big words, strong community. One question: will it grow or not? Most people look at price and marketing, but if you want to really understand the market, you need to dig deeper. The real power of a coin lies in its tokenomics, because tokenomics answers the main question: who, when, and why will buy this asset. Today, I'll show you a step-by-step algorithm on how to use tokenomics to understand whether a coin has real growth potential. We'll analyze specific metrics, websites used by professionals, and real examples of coins so that you can separate promising projects from duds. After this video, you will stop investing blindly and will know exactly what to buy and what to stay away from. Now imagine this situation. You bought a coin for $1. Seems pretty cheap, right? But what if another billion of the same coins appear tomorrow? Your dollar will very quickly turn into 10 cents. That's why the first thing you need to check in tokenomics is how many coins are already in circulation and how many more will appear in the future. You need to know these numbers clearly, otherwise you risk buying someone else's exit. Let's figure out how to do this in a couple of minutes. First, open CoinGecko or CoinMarketCap and find your coin. Go straight to the Tokenomics tab. Look at two numbers: circulating supply, how many coins are already on the market; total supply or max supply, how many coins will be issued in total. For example, the coin currently has 100 million in circulation and a maximum of 1 billion. This means that 90% of the coins have not yet been issued. And in the future, this will inevitably put pressure on the price. Now go to token.unlocks.app and look at the unlock schedule. If hundreds of millions of new tokens appear in the coming months, then the current price is not a discount, but an overvaluation. Remember Aptos, a project with a powerful launch, hype, and strong technology. But at the start, only a small portion of the tokens were in circulation. The majority was held by funds, and the team locked up. Once the unlocks began, the price started to fall, again and again, regardless of marketing, simply because supply was growing faster than demand. This is the power of tokenomics. You look not at the picture, but at the structure, and you understand where the price is supported and where it is simply temporarily raised by a shortage. But even if the unlocks are still far away, that doesn't mean the token is safe. Because the next key question is, who actually owns the coins? Many people ignore this, but it is the ownership structure that often determines how vulnerable you are. Imagine you bought a token, everything seems fine, and then the dumping begins. Why? Because 60% of the coins ended up with a fund that simply started to take profits. To avoid such a situation, the first thing I do is open Messery, Tokenomics, ownership. I look at how much the team has and how much the funds have. If insiders have more than 50%, that's already a red flag. When the price first rises, they may start to exit, and you'll be left with a loss. Next, I always look at the unlocking schedule. If it is linear, the pressure will be gradual. But if there are cliffs, when 20–30% of the entire supply is unlocked in one day, the market simply won't have time to react. Remember, in tokenomics, what really matters is not what's written in pitch decks and on landing pages, but who actually holds the asset, because it is these people who will decide whether to sell or not. Even if the distribution and unlocks don't raise any questions, don't rush to get excited, because now comes the most important part. What will actually make people buy this token? Not in theory, not sometime in the future, but specifically, who, why, and with what money will create demand. The project may have a cool website, a high-profile team, and hype on social media, but if the token is not needed by the protocol itself, its price is based solely on expectations. And when those expectations evaporate, the price is the first thing to fall. To avoid missing this, I go to Token Terminal. This is a website where you can see the real income of the protocol and compare it with its capitalization. I look at the FDV metric. Revenue is the ratio of total capitalization to annual income. If it is above 50, you are most likely looking at an overvalued token with no clear profit model. Next, I open Messery, Tokenomics tab, Utility. I look to see if the token is used within the network to pay commissions, access features, vote, or stake. The more use cases there are, the higher the chances of stable demand. But if the entire description of the utility boils down to will be needed in the future, that's a red flag. Finally, I open Dune Analytics or Defalama to see who is actually interacting with the project. Are there users? Are there transactions? Who pays the fees? If the metrics are growing, then the protocol is alive. And that means the token may have real value because in the end, investors don't buy promises, they buy movement, not potential, but demand. And if you see that the token is really needed and not just lying in your wallet for the sake of X's, that's already a strong signal. As you can see, tokenomics is not about pretty presentations. It's about numbers. And if you learn to read them correctly, you will immediately see where the real potential lies and where it's just marketing noise. Want to see how it works in practice? I've picked out 3 altcoins that could really grow 10 times in value, with real examples and fundamentals. There is a link to a video on this topic in the description. Be sure to watch it if you are looking for promising coins. Even if a coin has excellent tokenomics, that is no guarantee. There is one factor that can invalidate the entire analysis: liquidity. Imagine, you did everything right, bought a promising token, the price went up, and then you try to exit, and you can't. The order hangs, the price falls, and you lose money for no reason. Why? Because there is simply no liquidity. To prevent this from happening, I always check where and how the coin is traded. First, I go to DEX Tools or DEX Screener. I look at the pool. What is the volume? What is the depth? How quickly does the price react to orders? If there is $20,000, $30,000 in the pool, that's not enough even for retail, let alone a serious position. Then I go to CoinGecko or CoinMarketCap, open the Markets tab, and check which exchanges the token is traded on and what the real volume is there. If almost everything is concentrated on one DEX without normal turnover, this is a red flag. Additionally, I go to DeFi open the liquidity pools section, and see where the liquidity is actually locked. Is it on serious platforms like Uniswap, Curve, Radium, or is the entire pool placed on an unverified protocol where the volume is easy to draw? Liquidity is not a formality, it is protection. Without it, you won't even know how much your coin is actually worth. And most importantly, you won't be able to exit when you need to. And last but not least, another point that is worth checking before buying a token is real demand. Many people look at the price and the chart, but they forget. If no one is using the project, if there is no activity on the network, no commissions, no incentives to hold the token, then it is not needed. And that means there is no growth to be expected. To check this, I go to Token Terminal. 3 key metrics are important: protocol revenue, how much the network earns, protocol fees, whether users pay, DAU, daily active users. How many people actually use the project? If the indicators are 0 or barely moving, this is an alarming sign. The price may be high, but without demand, it's just speculation. Next, I go to Dune Dashboards, where you can see detailed analytics on activity, number of transactions, growth of new addresses, engagement. This is especially important for DeFi and gaming projects. 2 more resources are Artemis.xyz and Masari. They allow you to compare tokens by metrics: activity, capitalization, volume, TVL, number of wallets. If there is no demand, there is no sustainable growth. So don't rush into buying until you are sure that the token is integrated into the project's economy and not just sitting on the shelf. But even if you have chosen a strong project and calculated everything correctly, there is a way to increase your return without risk. In Solana, you can earn passive income simply by delegating tokens to a validator. But it is important not just to click stake. You need to understand where exactly you are delegating, what income you are receiving, and how you can optimize it. To simplify this process, I created a Telegram bot that does everything in seconds. Shows income for each epoch, average APY, uptime, and validator efficiency. Just enter your wallet address, and the bot will show you how your stake is actually working and whether you can earn more. The link to the bot is in the description. If you hold SOL, be sure to check if you're losing income right now. Hype passes, marketing dies, but tokenomics remains, because it is tokenomics that determines who will buy, who will sell, and how the price will move. If you want to understand the market rather than guess, analyzing tokenomics should become a habit. Just like looking at stock reports or evaluating business income. While others are buying based on pictures, you are learning to think like an investor. You already know how to read tokenomics and find strong projects. But that's only half the picture, because even if a token has good metrics, it is not always controlled by those who hold it. The real power in crypto lies with the DAO. And if you don't understand how they work, you're playing a game whose rules are written by others. In the next video, I'll show you who really makes the decisions in the largest protocols, how to vote and influence the course of a project, and why DAO are becoming the new crypto corporations where everyone can be a co-owner. To make sure you don't miss it, click like, subscribe to the channel, and turn on notifications.